Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, member Gunnar Gregory shares his path from working at Goldman and investment banking across two different groups, from joining a startup hedge fund to now branching out to run his own business. What he learned along the way, how he views mentors, and a certain mindset that helps him grow. Enjoy. All right, Gunnar, thank you so much for joining the Wall Street Oasis podcast.
Thank you. Thanks for having me.
So it'd be great if you could just give the listeners a short or brief bio of your history.
Sure. So I'm from the DC area. And funny enough, I actually started working in politics as a hobby at a very young age. And I guess actually with work, I really do mean internships. So I actually started doing that when I was 11 until I was 20. So it was a while. And it's actually not as weird as it sounds. My great uncle was Tip O'Neill, so it's pretty standard, I guess, for people in my family. But anyway, I ended up working for a bunch of people with financial services backgrounds at the Financial Services Committee in 2009 when they were working through the financial system, working on Dodd-Frank. And I learned what investment banking was. I'd never heard of that before and decided that I wanted to do that. So I started at Jefferies working as an investment banker my junior year, then made the summer switch, which is always tricky, junior year to Goldman, and ended up working for 4 years there after college. After that, went to go work at a hedge fund, did equity credit and activism, and then left to do my own thing and started a company called Vancery in 2018. And to date, starting a company has been the most fun, but that's what I do now. So
awesome. Thanks for the quick summary. So going back to undergrad, and it sounds like you were politics. When you were first applying for that like Jefferies summer analyst position, can you tell me a little about was there on-campus recruiting at your undergrad? What was that like? Because you were a finance history double major, right? But were you?
That's right.
Had you decided early enough? Was it far enough ago where they weren't recruiting sophomore year like they are now? Was it like a normal kind of sophomore, let's say spring semester type recruiting, or how did that work? Or early junior year?
I think it was actually my junior year fall.
Yeah.
So I guess it was more normal than that even.
Okay.
And I think what they did, there was a name for it, but they posted onto the school's website, I guess for a resume drop, maybe that's what it was called.
Yep.
And I was selected to do that after putting in my resume. It actually was for a satellite office for Jefferies, which I don't even know if it's around anymore, called, it was their aerospace and defense practice and industrials.
Okay.
It was based in DC. And so I just drove up there from William & Mary, which is based, William & Mary is essentially between Richmond and Norfolk, for anyone familiar with Virginia's geography. So drove up 3 hours to the interview and then got the offer.
Nice, dude. Congrats. So you got that offer. Basically, you knew right then and there, okay, can you walk me through kind of that summer? Was it long hours? Was it something where you knew this is what you wanted to do? And did you receive a full-time offer at the end of that summer? And was that how you were able to leverage or jump up to a bulge bracket?
So it actually was even a little bit trickier than that. So it was an exploding 24-hour offer.
Oh my gosh.
So I'd spent a lot of time. Yeah, I know. I spent a lot of time in New York. But I, probably was doing reading on Wall Street Oasis actually to figure out what to do. Mm-hmm. And decided just to take it, get my foot in the door, and actually really liked it. I'd done a lot of work. I mean, to the extent kind of somebody in college can do a lot of research in contracting and kind of what was going on then in Iraq and Afghanistan, which they were doing. Basically, that group was helping to consolidate the drone industry. So it was really cool. However, they were cutting back internship slots, and that group actually did not extend to any slots to any interns that they had that summer. And so I kind of had to figure out, I luckily already had a process ongoing at Goldman, and got into that. So kind of got saved there, but it was a bit of hit or miss.
So that was kind of, basically right after junior summer to that recruiting. Was it an accelerated process, or is it because you knew you weren't going to get a full-time offer from that specific satellite office, you kind of were already hustling while
they didn't. No, they didn't tell me that until actually after I was done in late August. So I was kind of intending on moving up to New York either way.
Okay.
So that was just kind of a process that was ongoing during the summer.
Do you think you would have taken it if they had given you the offer, or you felt like you had enough leads in New York that you would have turned it down and kind of gotten something else?
I think I probably would have gone to New York. I was working with or talking to some people at Morgan Stanley and Deutsche Bank.
And then how did you like get in there? Were you like networking earlier in the summer? How did you kind of have those connections?
Yeah. So that was definitely kind of the bright spot of my co-recruiting process, and what I try to impart the most to people going through it is that the community in my undergraduate program at William & Mary was just completely essential for me breaking into interviews and getting those opportunities. We had this really wonderful finance professor there who had actually been an investment banker herself. She was like a Fulbright scholar, all this other crazy stuff. And she was at Bear, I think, in consumer way back. And anyway, she took a kind of like a personal interest in all the students that were trying to work for, and kind of demonstrated willingness to work really hard for these opportunities.
Mm-hmm.
But she would connect them with other alums that worked at banks that seemed like a good fit. And so that was awesome. And without that, it would have been really hard really to kind of like get a leg up and to really know kind of like the subject matter of what people and kind of like the real world really want to know, because it's just so different from your finance classes.
So was she like actually was she mentor? Oh, okay.
Up with me
she wasn't mentoring
like
you.
11.
Okay.
Oh, go ahead.
She wasn't mentoring you directly. It was like it was just like she
So
had
she was.
Okay.
She was mentoring me directly. So she was even so open as, I mean, this is all in her free time too.
Yeah.
She would, like if you were to email her and say, hey, like, I got this interview at Barclays, and I'm going to be doing this phone interview, say in like 2 days. She'd say, oh, that's so great. Like, she would know it was going on. She would invite you to her office. And then she'd say, yeah, by the way, like, X, Y, and Z also works in that group. Like, you should talk to them, kind of get to know, deals that they've done recently, things like that.
Oh, cool. That's huge, because I guess going into the interview, you could kind of mention drop those names, I assume.
Oh, it's so big. Yeah. I mean, that it makes all the difference. And then they also at William & Mary paired me up with a mentor who had been at both Bear and Lehman, and he was doing private equity, and he would get on the phone and kind of drill me on valuation and accounting questions. And that also was huge. I needed a lot of help. So
tell me if this happens to you, because I went to Williams College. People are always like, oh, Williams & Mary. I'm like,
all
no.
The time.
Same with you guys? Okay, good.
All the time.
Yeah, because I'm like, no, not Williams & Mary. It's just funny. Okay, cool. So you get the offer at Goldman, luckily, and you're basically coming into your senior year, you have a job, right, lined up?
Yeah, that's right.
So it's a great senior year,
feeling.
I assume. Yeah. And then basically coming in to Goldman. So was it a specific group at Goldman? Was it in industrials or anything like that, similar to what you did at Jefferies, or?
Yeah. So we were working with the FIG group basically as like a leveraged finance function. We were helping with helping insurance companies and banks figure out their balance sheets. A lot of that was in relation to TARP financing when we first started, and that was really cool. A lot of it also fed into like triangulating the best like credit ratings for insurance companies, which for lots of people know, credit ratings are for borrowing debt, but it's also for insurance companies a pretty big marketing point, and it's usually in all their advertisements. So we would help a lot of insurance executives figure that out and work with the rating agencies, and then figure out kind of what's the best debt to go onto their balance sheets, and then line that up for them.
Got it. So that's
where I started, and then I thought about, and then basically I went through another process with the kind of M&A groups for FIG, financial institutions, and real estate. Got offers for both of those, and then went into real estate.
Got it. So you're doing M&A real estate deals, basically, under Goldman?
Yeah, that's right.
And how many? That was for a couple of years as well?
Yeah. And we were doing both financing. We did a lot of equity, capital market stuff, and then we also did M&A.
Can you talk about that
big LPO, like asset purchase for Blackstone?
Can you tell me about that internal transition? I know I've had other guests on here. It's pretty tricky sometimes, because you're working for one group for a couple of years, and it's like you have those relationships with the MDs and the VPs, and then you're kind of trying to, for your career, you're trying to move into another specific group that maybe you have more interest in. And I'm sure Goldman, it's a little bit maybe easier making that transition. They may probably have some internal process, but can you talk a little bit about that in terms of how smooth that was or how you navigated it?
Yeah, it was relatively smooth. I mean, I think that they kind of, the M&A groups probably look at it as kind of like recruiting from the live-in groups, and they kind of get a chance to work with those people and kind of see who's interested in it. I would say, it wasn't like anything. I wouldn't say anyone was anything but really pretty encouraging about it. They really do. At least then, they in the culture, they really did kind of encourage mobility and staying within the firm, et cetera. So that was great. I'd say maybe the trickier part was recruiting for two M&A groups and kind of having to figure out the modeling for both. Doing like insurance blocks of like insurance annuity deals, and then deals for like net asset value for real estate companies.
How did you even approach that? How did you even approach
the accounting's all different too.
How did you approach like studying for that?
Yeah, I used I kind of actually forget the software, but there's this great Breaking Into Wall Street. Breaking Into Wall Street had just these amazing modeling programs that you could do, and you could do them for most industry groups. And so I would literally just kind of hang out in coffee shops on Saturdays and Sundays and just kind of work through those for the free time that I had.
Sounds like a blast.
Yeah.
It
was so much fun.
So you obviously did well. You got the offer from both or one, or the real estate one, and you ended up going there. And then tell me about kind of your years there, and then what was kind of the impetus of looking for the jump to the buy side?
I mean, it was very hard. It was, it is certainly as demanding in terms of time as it's cracked up to be. It was really fun though. I look back on the experience very favorably. People spent a lot of time kind of training and mentoring, and that was great. I actually just got married a few weeks ago, and a ton of people from my group were there. I've gone to other people's weddings all over the world that were also my group. So it was a really good experience. And I think the fundamental thing that I learned from that experience was kind of more in the realm of kind of like deal structuring and deal process, and kind of how deals work around, the personalities of people in the deal. Later on in my career, when I worked at a hedge fund as an investor, I think was when I really, really sunk my teeth into technical analysis and kind of figuring out like what is value. In investment banking, not to knock it at all, because it's a very hard job and very lucrative, but you really are learning, I think, first and foremost, deal structuring as opposed to kind of like the valuation. Right.
Can you tell me about a little bit, like when you were thinking of, hey, this is the right move to make for me next, is kind of jump to the buy side? Was it just because the buy side tends to be held in higher regard in terms of lifestyle and in terms of pay? Or was it some other?
I mean, I thought it would be a lot easier, which did not turn out to be true, and less stressful. And also, I think I have a sister who's 8 years older than me. So when she was, she's probably about your age actually. When she
pretty old.
She was her kind of contemporaries were on Wall Street, kind of in the 2000 to 2005 range. So, all the people that were in kind of the buy side just had the meteoric careers, and that really is not quite the case anymore, with kind of, the industry going through a bit of consolidation, and fundraising is a bit different.
Yep.
So I definitely didn't have that insight, when I was a banker. So, really wanted to go into it, and honestly also just probably wanted to go into it because it's just like the hardest thing I could do, and just wanted to see if I could do it.
And so you were there for a while, even though it was hard. In terms of, like you said, banking's lucrative, and I assume, the hedge fund was lucrative. Do you mind giving the listeners kind of a range of what you were making at Goldman, and then kind of what the pay jump? I assume there was some sort of pay jump at the hedge fund.
Yeah, I think so. At Goldman, it was, I think for kind of older analysts, it's like you probably make around like 150 to 200. It's been a while since I've thought about it. A year, it's probably like 90-ish to 100 for your base, and then probably double that for your bonus. And then going into a hedge fund, you usually make like low, 6 figures for your salary, and then actually there's a variety of different compensation scales, particularly with a lot of the jobs coming out of the much bigger kind of platform companies. But in the traditional hedge fund model, it's like you get something called phantom equity, which is just basically like percentage points in the incentive fee. And that incentive fee is notionally or like by the actual number of dollars is based on the actual amount of return that your firm generates. So you as an investor will have, call it like 5% or 5 points in the incentive fee. And so basically you get 5% of whatever your fund or your team has generated for your investors.
And was it a small enough fund?
Sorry, let me correct that.
Yeah.
You get 5% of the 20%
upside,
right?
the carry.
20
of the carry.
Of the return. Yeah.
Of like the upside carry that the fund really can make their juice on. So
yeah.
were you...
Which can be nicer than a private equity fund where you have to wait around for it for several years.
Right. Meaning because on the Phantom, you're actually getting paid out on the Phantom equity like each year, like a bonus.
That's right.
Yeah, that's great. And then are you specifically like, was it a small enough fund where you went and you were getting something as high as 5% as an analyst right out of a bulge bracket? Like you're 4 years out of school where you...
Yeah, mid-single digits, yeah.
That's great. Yeah, so this has big potential upside, right? If you guys have a good year.
Yeah, it was great.
So so there was obviously you said low six figures on base. The bonus can obviously range anywhere from 0 if it's a bad year, right, to all the way up to I assume several $100,000 a year. Is that accurate?
Yeah, that's right.
Okay. And then specifically on that, like, tell me about that. Was it the types of investments you guys were making? It's specific, like, were you looking at a specific sector? Were you doing like long short?
Yeah.
Were you doing event driven? I'd love to hear a little about that.
Yeah, for sure. So we were doing long short equities mostly. We were pretty focused on U.S. real estate companies and home builders and developers. But we also did, I'd say some of my coolest investments were kind of I went to Australia fairly frequently to kind of underrate real estate opportunities. We did activism. The real estate sector, publicly traded and privately traded real estate sector, is known and it's a bit notorious for having some conflicts of interest with management and kind of governance issues. So we would get into that fairly frequently. And then we did some credit. So
can you unpack that? Sorry, I don't...
a bit on like the Toys R Us.
Can you tell me a little bit more about that, the management thing, and the conflicts of interest and what's in real? Because I'm not too familiar with real estate. Can you? Yeah.
So probably an important thing for a lot of people that are getting into the investment community is kind of understanding where the incentives of your management teams are. So for instance, in the real estate sector, a lot of the times you have to look out for a management team that gets paid off of the base of assets or say like the size of revenue. Mm-hmm. And the reason for that is that it's not, the revenue isn't necessarily, or the size of the company is not necessarily correlated with returns for equity holders. So let's just say, you owned, REIT ABC and you took out a bunch of debt and then you bought a bunch of assets that aren't very good. If your compensation is actually tied to the value of your total asset portfolio, you get paid more for making a bad portfolio.
Right. Makes sense. You're just building the base as high as you can, as fast as you can.
That's right. Yeah. As opposed to kind of creating like accretive growth.
Cool. So you're there for almost 3 years, and tell me what's going on there. I know the hedge fund world, it's tough to hang around for too long. But tell me, was it stressful? Were you sleepless nights, or did you take it in stride, the losses with the wins? How was it like emotionally and psychologically?
It was definitely challenging to get up to speed. I got a lot of training, so that was great. I think the toughest thing probably that people should probably be aware of when they want to go into investing in like the public markets is just a big change in your lifestyle will be whether or not you're investing in foreign exchanges. So at like various times we would have risk on, or we'd be invested in companies that were on the DAX in Germany, on the LSX, in London, on the American exchanges, and on the Australian exchange. So there literally would be no time of the day when numbers were not going up and down of like your pricing for your securities.
Right.
So that was pretty tough because, you're kind of expected to know all the releases that are coming out and everything. There'd be earnings calls at like 3 a.m. It was that part was pretty rough. But the experience of taking and we were usually looking at kind of smaller capitalization companies. So you ultimately, in sinking your teeth into something would kind of become one of the smartest people in the investment community on a certain company, and you would get to travel and learn all about it and meet the management team and kind of create relationships with them, which was really rewarding, especially when things worked out. So.
Did you find it tough, like when you're building those relationships, like if you had a negative view on a company, like to keep it a positive relationship, or did you feel like you were typically, or most of the time, going long, so it was a amicable kind of exchange?
I actually had a tough time not making good relationships with people. That's probably why I'm better suited to being a startup founder than a hedge fund investor. But I generally kind of had a good time meeting with most people.
Cool. And then, what made you kind of think, hey, it's time to branch out on my own and try this entrepreneurship thing? What kind of, has it always been kind of in your DNA, do you feel like, or is it something that you're just had to get out of your system, or what's going on? And I'd love to hear about your new business.
Yeah. It was probably always in my DNA. I didn't really know that. But what I kind of started to realize was that I really loved, these big trips, going to Germany, going, all over the US, going to Australia, to figure out, different opportunities, to kind of put together networks of people that could kind of help us figure out things. And what I really didn't like as much was kind of sitting around and just looking at my Bloomberg screen all day, which was probably, 5/6 of what I was doing. So I kind of realized that what I really like to do was kind of just honestly pound the pavement. And even harkening back to when I was recruiting for jobs in New York and kind of just going around getting coffees and just meeting with people, it was almost kind of similar to that. Mm-hmm. And most people that I end up talking to that are kind of going through that process just absolutely hate that. And, I think kind of just wish that part that wasn't part of the process. In the end, though, I think for many people, I'm sure you've run into this too, Pat, that kind of hustling and kind of figuring out where opportunities are and kind of putting one and one together that aren't necessarily obvious are big things that will come into everybody's career for fundraising, for hiring people, for finding, new deal opportunities. So that was kind of something that I really like and that I get to do a lot more now.
That's cool.
And then, sorry, there was a second part of your question.
Yeah, just I'd love to hear what the actual business is and what you guys are doing and how's it going and all that.
Yeah. So my company's called Vancery, and it's a technology company. We employ a team of software developers and marketing people that basically provide market research to investors and consultants and corporate clients. And I guess the closest thing to traditionally what our company does is an industry called the expert networks. Have you ever heard of those, or should I explain what that is?
Yeah, a few of them. It's the big one is GLG, is it? Or there's been a few of them, right? Where they basically, specifically.
Yeah. So many investors use them. So that might be of interest for listeners. Essentially, the idea is, you consider your desk, and let's just say you want to learn how Apple picks semiconductor providers in Taiwan. I don't know if they do, but I guess they probably do. And you would just shoot off an email to someone, that's your coverage person at one of these companies, and they would just, lo and behold, just find you someone that can tell you about that in Taiwan or that knows about the supply chain.
Right.
There's a bit of an issue where there's always kind of this asymmetry of sophistication between your coverage person, who's usually very junior, and then just imagine a 35, 40 or 30-year-old investor. And then they need to talk to a very seasoned, corporate executive or former executive. So the person in the middle never really knows 100% what's going on. That can create some negative experiences, and actually commonly does. So what we are basically doing is creating kind of an online platform to fix that. And so, it's a lot of fun. It's inspired by, what I used to use them all the time, and often would have to go find my own experts and kind of far off places. So I kind of got the inspiration to do it from that. And
are there specific,
my job changes day to day.
Are there specific experts that you guys are honed in on first, or you just already had good contacts with that you're kind of focusing on? Or is it
all of the above, really? I mean, mm-hmm. we really focus on the healthcare and technology sectors. So we're working with a life sciences consulting firm that works a lot with pharmaceutical companies.
Got it.
So that's a big area of volume for us. And then also kind of from my own, network back in DC, we have a really big kind of government affairs pool of people, which is very relevant for, all the Trump to trade war stuff, just kind of everything that's going on with different types of regulation, potential changes with healthcare, from like the Democratic debates, all of those types of things kind of drive questions that drive kind of business for us.
Very cool. Very cool. So yeah, I assume it's a lot of like just network building, traveling and meeting people and getting them into your network and explaining what you do.
Yeah, exactly what I wanted. So yeah.
That's cool. Yeah. It sounds like it's right up your alley. Awesome, man. So anything else you'd like to share with the listeners before we call it, like in terms of feedback or advice you would have given to your younger self, looking back, even though you're still pretty young?
Yeah, I mean, I think, a lot of things I would say, but one thing is really just ask more questions. I think, that's a common refrain that people hear, but it honestly, taking the mindset of I'm just going to grind this out in terms of, interviews that aren't going well, or, if your MD gives you, a deck skeleton on Friday afternoon, all of those things are opportunities when, and things like that, for your personal life or aren't great, or, they don't emotionally feel good, or usually opportunities for you to grow and to learn stuff. And I do that literally all the time. Like Advancery, we have this insanely good group of advisors. One of them was the CTO of CapIQ, which for I'm sure you remember, Pat, that it used to be kind of like the gold standard for financial data.
Yep.
And like another guy was like one of the first people at Instagram. So I spent a lot of time on the phone literally yesterday with them, just kind of brainstorming and just asking questions and trying to think of dumb questions. Cause like for me, the things that I don't know are what will hurt us.
Yeah.
So I try to ask questions as much as possible. And I think that that's something that every analyst, every college student that's trying to get into a new job should be doing as much as they can. It's just aggressive learning.
Yeah, I'm into that. I think hopefully they can do some self-learning in the community, and then use their coffee chats with professionals to kind of dig in deeper on specific topics that they want more info on. But yeah, for sure. Great. Well, I appreciate everything, Gunnar. Thanks so much for taking the time to join us. And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, patrick@wallstreetoasis.com. And until next time.